a bank account and say a debit and credit card. Anything else, you don't particularly feel a benefit to going to them. I mean, you would just shop around or just try and find the thing that's the most convenient for you.
Because they're saying, listen, you're right. ICICI does a great job of trust. I can give them my money. But are they the best place I can run my investments through? Because I want low cost brokerage, because I don't want the advice they're giving me. Because startups don't understand the nature of this business. The fact that a regulator has said no to you for whatever reason should not really reflect on what another regulator does. But if the regulator is the same body, it's RBI.
Hi everyone, welcome to the Capitalmind podcast. My name is Shrey and I'm sitting with our founder Deepak Shenoy to discuss the financial services industry and understand why every single company you want to interact with is trying to offer you all solutions that it possibly can, and how regulators are looking at this and dealing with that dynamic. So do listen in. Deepak, there's this famous saying that the way to make money, the only way to make money is to take a business which is bundled and unbundle it, and then to take businesses which are unbundled and then bundle them again. And I guess when I look at fintech apps today or fintech startups today, I think they're in that journey where they're taking many disparate activities and trying to bundle them together. And this does make some sense. You're already using the app for, say, activity A, and why not also add on, say, bill payments, there's credit, so on and so forth. But what puzzled me about this is there is already a player, a very large player in this space that does all of this. It's your, well, maybe not so friendly neighborhood bank. And they are truly the biggest, if I may call, bundle of financial services out there. You should be able to get pretty much anything done over there. So how is it possible that in the backdrop where you already have banks offering these all of these solutions, you can have fintech players, I mean, attacking one niche, I get it, but attempting to build a bundle around it, how is this even possible today?
This is actually, firstly, I think we have to figure out why do banks offer everything, or why do everybody offer everything. My uncle who was a banker, and I didn't know him as a banker, but a journalist actually told me that this is a statement he made, was that a bank needs to be everything and needs to be a lot of things to people, because they should not be just borrowers and lenders. They should also be people who help you with your insurance, with your factoring, with your short-term packing credit, forex exchange, everything. So they should be a one-stop shop. This one-stop shop concept applies today also. So you look at Kotak, who is a bank. Kotak Mahindra is a bank that started in the 90s, and I think we're now not just a bank. We're not talking about an asset management company that manages mutual funds. They have a securities business, they have an insurance business, and a bunch of other things. HDFC Bank is also similar. HDFC Bank actually has an NBFC that also lends. HDFC Bank also lends. HDFC Bank's underlying NBFC called HDB Financial Services also lends. They have merged with HDFC, which was their parent, the housing loan entity. But HDFC also now effectively has a company called HDFC Sales, which is the sales agents for their housing loans. So why do they have, apart from this, they have HDFC Securities, HDFC AMC for the mutual fund, HDFC Insurance, life insurance, HDFC
non-life,
whatever, non-life, I guess. But the idea over here is you're a little bit of everything, because your customers are the same, right? So you look at the customer and say, listen, he's coming to me, he's depositing his money, but he's also investing his money. Why can't I, help him invest his money and make a small fee of that as well? The incremental cost to me is relatively small. So this builds up, and then eventually you have branches, because banks have branches, physical branches everywhere. The people sitting there are like, listen, you guys have set up all these ATMs and all that internet banking. People are not coming to us anymore. What do we do as a branch? Maybe almost magically, the answer is go sell them anything. So the minute you go deposit your money, they're like,
have you considered?
By so then almost there was this. I recently talked about somewhere else. This cartoon about a guy who says he's going to a bank with a gun, but he's like, I don't want any other product. Just let me deposit my money. But that's what banks have become, because the idea was, I have all these costs that are already there. Can I sell the maximum amount of? So you've got all these products, right? If you look at the fintechs, they're also coming down a similar route. Let's talk about, say, a Navi, which started off with Sachin Bansal starting it, I think 2 or 3 years ago. I think the idea was he wanted to become a bank, but in the process of applying for this bank, he bought a microfinance company, he bought a mutual fund, he's investing in insurance companies. He's also trying to get into the spectrum game, right? So because the game is in the spectrum, it's not in any individual entity right now. I mean, I'm saying this as a maturity end, because the maturity part of the process is first you start with, I will get my first 100,000 customers or first 10 lakh customers. The minute you get there, you're like, oh, I've got so many wallets. Can I now get a greater share of every single wallet? The issue with this is, of course, you'll end up with a little bit of, craziness, because like you said, the banks exist, but they don't necessarily serve the customer in the best way.
So I'll interrupt you here because look, I completely get the logic, but here's how I think I have a great bank, and it's ICICI Bank, and I'm quite happy with it. But even then, even having a solid relationship or account with them, by and large, as a customer, you'd view them as like a bank account and say a debit and credit card. Anything else, you don't particularly feel a benefit to going to them. You would just shop around or just try and find the thing that's the most convenient for you. So, or perhaps the lowest price, or that does exactly what you want in a different way. So, what you're saying, I get the logic, but it also doesn't seem to work beyond a point, because there will always be people who can attack the problem better.
So the interesting part about it is the greater wallet share is actually usually not the same. So the discerning customers are now going to people who are specialized, because they're saying, listen, you're right, ICICI does a great job of trust. I can give them my money. But are they the best place I can run my investments through? Because I want low cost brokerage, because I don't want the advice they're giving me. So I will go to a lower cost brokerage and a company that is very specifically brokerage oriented. Although that brokerage company also is trying to expand into different things. Okay. He's trying to sell me a loan for it. And I'm like, dude, I'm not going to take a loan from you because I have other places to go to loans from. So I'm the discerning customer who's going to different specialized players for different products. And this is also manifested down the line. If you look at it this way, banks are big, but the biggest broker is not a bank. The biggest broker is Zerodha and Grow, for maybe not in that order now. But the idea over here is that these players became specialized at, say, broking and the services they provide, that the biggest mutual fund distributors used to be banks, because you go to a bank, the bank can sell you a mutual fund and earn commissions out of it. The biggest mutual fund distributors who earn commissions, one is called NJ, which is, again, NJ was started as a mutual fund distributor aggregator. So it aggregates a bunch of distributors under them, and then they kind of are the front face of it and everything else below. But they are now the biggest distributors by a fair distance. They're more than, I think, nearly 2x in terms of commissions compared to the next biggest, which is either ICICI or HDFC Bank. And then there's SBI. And then a few other players like Prudent and a couple of others. They're all big commission players in this space. So the biggest players in some of these spaces are no longer the banks. They are specialized players here, which is because while banks are big, it's not like ICICI is any smaller than these companies. It's just that the banks are big because they have a spectrum of products, but they may not be the best in any given product. There's a layer that has said, and this is a curse of the market, right? If you do too many things, you will probably do too many things but not be great at any one of them, which means, and you want it that way. Perhaps because when you do all the iterations and combinations, if you become really good at one thing, people don't give you the other parts of the business. Whereas if you're mediocre at a lot of things, you get enough that the aggregate amount of money you make is actually higher in mediocrity than it is in excellence in any other. I hate to say this, but in the US, the biggest mutual fund was not JP Morgan. It's BlackRock and Vanguard. And BlackRock was a sort of risk management software, and Vanguard was a guy telling people to buy passive funds. Beyond that, you suddenly got trillions and trillions of dollars managed by these guys. And even Bloomberg, which is a data product, you would think that banks have the most data. They would obviously have the most quality of. But Bloomberg emerged out of an investment bank. Bloomberg himself was working at an investment bank, and then he kind of. But so I think products that are specialized may not necessarily have banking investments. There are exceptions. Visa, for instance, is a banking product. It's a bunch of banks that have come together and said, you know what, let's create a third-party entity that we can still continue to charge fees from. So it's a very meaningful money for Visa.
Well, Visa seems bigger than almost all the banks. But
It has become that way, but the banks have a stake in it. So in the sense of they started by the banks, they have a stake in it. NPCI in India is also, I think, funded by a lot of the banking system. So in a way, some of the innovations are through banks themselves, but a large amount of the innovative process also comes outside. So the idea of getting a greater share of the customer's wallet does not mean the greatest share of the richest customers' wallets, because the richest customers are discerning. They figured out that bankers just charge you a lot of fees, so therefore we won't do it. So beyond a certain point, it's the wealth management firms that come in, and banks are not the biggest wealth management firms in India. The other part of the process would be the poorest, who, honestly, the banks don't like so much. So if I look at, I think we had to discuss this in a bunch of other places, but we've talked about this. Banks, when you look at the poor people they look at them as relatively low income, people, and the money that they keep is fleeting and temporary. So if a poor person comes in, I am going to reduce my service as much as possible. I mean, this is not all the.
Well, you have some experiences yourself now. You stand back before the days of UPI and net banking. There was some standing in line for tokens to make a transfer or something.
Yes, in fact, UPI was popular at the time. This was, I think, just about little bit around the demonetization time, or just after, or maybe before. But they were these people who were standing in line, and I went and stood in line because one of the places that I was going to in Hubli decided that I had to deposit cash into their account. And of course, it was not illegal stuff, but the reason was that you had to deposit into their account. And since I was going the next day, I couldn't give them a check. It would take 2 days to clear. And for some strange reason, they said no transfers, no nothing, you have to deposit. So I said, okay, we'll do cash. And we went, and I had to withdraw cash to go and stand there. I stood there in line. Somebody came to me and said, sir, this line is not for you. So I'm like, isn't this the line to deposit cash? I said, yes, but they're all standing, and they have tokens and all that. You can just come straight to the counter. But I'm like, why was it that they have to stand in line and get tokens and I don't have to? It's the same process, right? So they're like, no. So it turns out that in the morning, they are laborers who are sending their money back home. They are sending money to a non-home branch. Their home branches are in their villages. I also said, listen, I'm depositing for a guy who wants the money in Hubli. So obviously it's a non-home branch for me. I said, no. But they were like almost apologetic to the extent of, they realized there was some kind
won
of a
on
system.
the social profiling.
Yeah, social profile was the problem. And then I was like, this is straight. So I went in a little bit more, and I found out these people are depositing 1,000, 2,000 rupees. This is their wages for the week that they have saved and that they're depositing so that their families back home can withdraw the money from their local branches. And they're standing in line. So the person in front of me told me he had to come in the morning and taken a token, early morning, to take a token. And then they would allow the people with the tokens to stand in this line. They would only give a certain amount of tokens per day. And then at the end of the day, if you're standing in line with your money and the person just left for lunch or whatever, you would not be able to deposit your money into your branch, into your bank account. And I was like, this is insane. They're not letting you deposit money into your own bank account. Whereas if you're a slightly better social profile like me,
You can walk in.
You can walk in and do all this stuff. So I wasn't even a bank customer, right? I don't have an SBI account, and yet it was a revelation to me. But then I realized this is the reason they don't like banks so much, and perhaps this is something that's changed in the last 7 or 8 years. But I still think that this is a problem because the wallet share business, all this, I will go across the spectrum. They can't do it to the poor people, right? Because they only have one product they can sell them.
So, I mean, I guess a bank in a sense is the reason it has the very many customers it does is because of trust and convenience. But when you go to the very high end, they become more discerning or just discerning how wealthy they become, and they sort of move out of banks for many services and solutions. And the lower end of the spectrum, because perhaps they're not treated as well to the extent they can, which they may not be able to, they try to avoid banks. I do hear this, and this is reminding me of something. This is a bit tangential, but it's still related to banks because we're on the topic, which was that I've heard from at least a couple of people that banks have also not been very aggressive to grow. I guess this is targeting, and this seems so absurd to say because when I look at HDFC Bank and Kotak stock prices over the last, many decades, clearly at some level they've grown extremely well. But I think the criticism being levied, and would love to hear your thoughts on this, was that they're happy growing at a certain cadence. catering to a certain type of customers, maybe incrementally moving beyond that in the name of prudence, which may or may not be correct. But they leave large gaps. There's a very large percentage of the population or a very large number of use cases that they're not able to cater to. Do you agree with this criticism? I mean, is this true? Are they leaving like big opportunities for other companies to come in and solve?
I agree. I think that's also true because in the process of growing, there are two things to it. Let's start with the growth problem, and then the fact that they don't address the market is a different problem. There's a second problem, right? So the growth problem is this: we think that banks don't grow very fast or not aggressive. The thing is, they don't want to grow very fast. If you grow too fast in a regulated industry, the regulator hates you, everybody else hates you. Somebody will go and whisper and say, bring you down. Yeah. So because they think you're doing something crazy and stupid. Even though you may be offering a product that nobody else has. And once people start to discover it, they love you and they're coming to you and all that stuff. They're like, no. The regulators are like, you can't be growing at this pace. Something is wrong. You will do something stupid in this. So to that extent, they have to massage their results to grow at a deterministic pace. And I say this specifically with the mind of, say, to give an example, the HDFC Bank was known as the Excel sheet result. So because you could literally put their last year's result on an Excel sheet, multiply it by 0.2 or 0.25, or 1.25, which is 20% growth or 25% growth, and you would get the profit number for this year. Even before the results were announced, you could estimate that this is the kind of profit they're going to show, and they would come close to it, right? And the reason is, banks invent their own balance sheets because they can determine that some things can be moved to next month, next quarter, something. So you can change the construction of your income, and then you have provisions, some of which are what are called voluntary provisions. So you say, this month I'm not giving enough. This month I'm giving too much provisions because I want to take down the income this month, and I'll take it away, coming back next month. So I think that process is because of this. If you grow too fast and non-deterministically, you will end up with this situation. Aditya Puri, he's a great guy. At some point, he said that if the Indian economy grows by 12%, banks should grow by 25%. And
I think that did happen.
That did happen. Yeah. And then 3 years later, he said the same thing, and banks should grow at 18%, 1.5 times the GDP growth. So I was like, but you said 2x last time, it's 1.5. Because these are numbers. They're just, I can make it whatever I want it to be is what he's really saying. Because it should be below. Yeah. But it should obviously be, it can be a number that we determine and then we can go to it. When banks do that, there's also a reason why then they don't want to grow too much. So if you give them ideas that will massively grow, they are not quite as interested. The fintechs on the other hand, I love it, right? They love the fact that you have a decent market and we want to grow like crazy. They have the other problem. If they grow slower than insane, their investors hate them. So they're almost like, show us 30% growth month on month. So the pull and the push of the banking system is the pull of the banking system becomes the push of the in a way. So I think that might be one issue that started to happen of why banks are not aggressive enough or rather in that sense. But there's another problem. Like I said, banks are mediocre at a lot of stuff, right? So they like to be mediocre at a lot of stuff.
By design.
That means they get blindsided by technological improvements in certain spaces. I'll give you the reason why Zerodha, and I've seen the Zerodha story from inception to now, and I think we've grown through, Capitalmind itself has gone through it. But one of the things that did happen somewhere in the middle was the world went to digital in a big way. So every broker that was relying on physical distribution of the kind that says, I will have branches in every city. Zerodha was like, just come to us digitally, we'll give you a piece of software that you install on your machine. That was what they did earlier. The biggest traders in the country were like, we would love that. Other brokers were saying, nobody wants software on their computers. They will call us and they will ask us to tell them what to buy, and we will tell them what to buy, and then they will buy, and we will buy it for them. The customers that are going to Zerodha were saying, no,
I don't want the other person.
I don't want this other person to give me drama. I just want to instrument myself. So this technological shift happened. None of the banks saw it. None of the big brokers, older brokers saw it. And by the time they saw it was too late. Everybody hated Zerodha to the extent that they got a lot of flack from, say, NSE would come and say, how are you selling 20 rupees per trade? This makes no sense at all. We will inspect you. They inspected them like crazy.
Everyone was like, surely you're doing something
surely
wrong.
you're doing something wrong, right? So it's almost, so you got that ire because these guys were growing fast. So in that sense, they get blindsided by technology. They get blindsided by some of the reasons why these aggressive pieces don't work is possibly because banks don't want to be great at the service. I don't want to be magnificent at the service they provide. And in some cases, they get their business on a platter. For instance, you can't do Forex in India meaningfully unless you are an authorized AD1, you have an AD1 license, authorized dealer, first level license, which is not available to anybody but banks. That means today I can't go and say, give me your authorized dealer license. They'll be like, dude, you're not a bank, we're not giving it. So to that extent, I think that is, this is an unstated policy. I don't think it is only restricted to banks, but only banks get it. Primary dealers were selling government bonds. The RBI wants retail to own government bonds. But guess how many people are actually offering it? Now, all the brokers offer it in the sense of the primary auction. You can go through a brokerage network and RBI will pay you a small commission. So they're allowing somebody to do this. However, the issues that happen in the longer term are that RBI wants retail to invest, but there is a secondary market for it. RBI controls this market. So there is that problem of currently the entities that are required to do certain things. The banks are the only way to go. I think this is one of the problems that we have to solve and say that, listen, everything can't be done only by the banks, especially because you're giving them business on a platter. RBI says talk to a bank, but at some point, I think we'll have to address that bigger. The one guy possibly that has, maybe changed this equation is quite different.
I thought of one thing that maybe doesn't fit your examples, NRIs. It seems like there's a big enough market there, but every time an NRI comes to us asking for help with something, we sort of just throw up a hand saying, dude, beyond a point, we can't help you here.
Totally agree. In fact, to the extent that I wrote something about NRIs and then we, people from RBI got in touch and we talked. The problem is the rules for NRIs are almost treated like, in some cases a better class of Indian citizen, in many cases a worse class of Indian citizen. For instance, the kind of KYC that we have to do, we can do it online, we can do it with our Aadhaar and stuff like that. NRIs, because some of them don't have Aadhaar, have to send physical documents, so notarized by the consulate of the country, etc., which is such a pain. We are the largest remittance input receiver in the world.
Okay.
We're 100 and something billion. China is less. China was a little bit higher than us. China is now much lesser. We are the highest. Remittances are a special form, right? It's money that comes in that doesn't need to go out again. It's non-repatriable money that comes in. Remittances, India is one of India's greatest balancers of the current account deficit in general. So, now, for a country that has so many people outside that are sending so much money that we are the largest receiver of it, we surprisingly hate our NRIs. And the only guys who can fix this problem, unfortunately, is the banks. And guess what? The banks don't care. They're like, we are going to give us your business anyway. So if I make your life a little more difficult, what problem is there? And the problem is, it isn't the bank. The sales managers of the banks want to make the sale. The compliance guys are like, no, he's an NRI. Can we see him? Can we get his blood test done right in our bank office to make sure his blood is real and it's his own blood? That kind of stuff. So at some level, this is the fear of the RBI at some level, because they have insane levels of compliance. But at another level, it's like there is no reason for them to compete. Because every bank is the same. There's no bank saying, listen, I will create a unified, proper level of KYC. And once you do it, you never have to do it for any other service in the bank again. Because we have a commonized system. Everywhere else, they've done it. In broking, they've done it. For instance, they have common KYC across all mutual funds. So you do one KYC in one mutual fund, it's done for everything else. The system has evolved down to that level. In NRIs, the system has just not happened. Surprising, because people sitting on the outside and they're looking and saying, I can invest in every other country except my own.
Yeah, we literally have people waiting to give us crores of money, which we simply cannot take because it will be too painful.
In our particular case, it's painful because they insist that an NRI needs to have a separate bank account in a managed service. Whereas in India, you can have a commonly pooled account for domestic residents and, basically individual demat accounts. So when we buy in the common account and this fan it across to every investor. So everybody gets the same price, whatever price we buy every day. You can't do that for an NRI. You have to create a separate trading account, a separate bank account, and a separate demat account. Separate demat account is there. But to create a separate bank account or demat, it's just process overhead of gargantuan proportions for a PMS that wants to keep the cost low, even for the customer. So what happens is the NRIs end up paying something like 200 rupees a trade, even in the cheapest brokerage in the country, or so on other brokers are like, listen, we don't want to deal it. Because every time you do a trade, we have to report it to a PIS something, to an authorized dealer, one bank, who wants the details of when the trade had happened and all that stuff. The minute they sell, sometimes it's the minute they sell, sometimes it's the end of the quarter that they sell it. I have to deduct tax on whatever profits were earned in that period. It's not exactly, so the rules are not clear. Nobody solves this problem, and then you create this situation where banks are the only arbiters. You've given so much power to the banks. People with power will abuse it. We've seen this in pretty much every sector. And because RBI with its power, and I talked about it, has possibly gone overboard in the regulation in some ways, but that's one layer of power. But they've devolved so much power into the banking system versus giving it or spreading it across and creating a layer of trust, is that now the bankers become the arbiter of that whatever the service is that they have to get. Nobody else can do it. NRIs can't even send money to India without using the banks at all. I mean, RBI only wants it that way. You could have had a solution using Bitcoin or crypto. I'm just saying, but you can't have it because they want all the information to come only through the banking system. You can't even have a company like us, for instance. If we have to receive a payment from abroad, that has to be reported through and through. If you get money from abroad, your banker will call you and say, why have you got this money?
What else?
Yeah, and then the problem is now the banker is also selling you services. We've had problems where when we have customers, they give us a 50 lakh rupee check, right? We deposit the check. The customer gets a call. I've got this check. We were to clear this check, but why are you investing 50 lakhs with Capitalmind? We have another PMS.
Okay.
So,
yeah, I've heard of
I'm like, wait. The banker is not supposed to do this, but guess what? You've first of all created this megalith in a way that does everything. Then you've told all the bank managers your goals are fees. So the guy who's supposed to clear my check is basically saying, can I jip this guy
and try
receiving the check, and instead of that put it somewhere else. Maybe they are successful in a few cases, I'm sure, but when we get to know, we only get to know the cases we get to know, right? So it is that, I think, that creates a problem. But I think there are other examples also. We've seen other companies come out.
So the one I was going to go to is, fine, you've said for regulatory comfort, banks wanting to be conservative, around 20% growth is considered awesome. But there are entities, Bajaj Finance is the one that comes to mind, that probably do that every quarter or something, or did that for the longest run every quarter. So how did they manage to break through all of this and not face the same level of, perhaps, if I may say, pushback? Or I know they've got some recently, but they seem to have had a very glorious run on this.
It's quite remarkable the way they came through, because they came out of Bajaj Auto. They were financing the automobiles that Bajaj Auto was making, right? So you're in the end, you were a financier of that. Then you came out of that. The brothers the younger brother got Bajaj Finance. He appointed a great guy and to run the business. And that business grew slowly from where it was to the behemoth that it is today over a period of time by just doing effectively what the bank should have been doing but weren't. And there were many reasons why they weren't doing it. For instance, they started off saying, okay, we'll do retail personal loans. Banks were saying, we want to do corporate loans. So the retail loan business, which was only attacked by HDFC Bank at the time, which also grew quite remarkably during that period. But because of the other banks focusing on corporate loans, is a very large area. So consumer loans, which was when you buy appliances, I want a loan to buy that appliance. Guess who figured this out first? It was Bajaj Finance. They said, if you appoint people that sit over there, as soon as you come to the billing counter, they say, why are you paying for this? Why don't you just take a loan? And then you gave a little bit of commission to everybody involved. And then,
everyone was happy.
Everyone was happy. You could do 0% EMI. I bought a camera in 2002 from Bajaj Finance on a 0%.
Oh, they were there back then?
Apparently, 2002, 2003, yeah.
Okay.
Sorry, yeah.
Well, okay, we'll
yeah, it was there. It was there. There was a
Fine.
Bajaj Finance model at that time. 2000 at that time, I think it was inside of Bajaj.
Okay.
And Bajaj Finance had this thing, and then Kotak also had an NBFC that was doing car.
So I bought the stock. Just
So, well, at that time there was no stock. The stock got demerged in 2000 something.
All right.
5, 6, 7. So, but and plus I didn't know anything about stocks. Why was I buying cameras on loans? I don't know. I have no idea why.
You were clearly not making the best financial decisions.
I was bankrupt or close to it, and I decided I will buy a 48-inch projection television also at the same time on a 5-year loan, which my wife probably teases me to this date, but not probably, she does tease me to this date, saying that was, I can't believe you had a loan to buy a TV running for 5 years, which even lasted to beyond our marriage. Luckily not much beyond, and I have since never taken loans to buy TVs, thank goodness for that. But
so Bajaj Finance found this opportunity.
And then the interesting thing was they were blindsided. The banks were blindsided because they saw this guy coming in. They were like, okay, there was another set of reasons. There's an arbitrage between NBFCs and banks. They have,
Is or was?
Well, I would like to say was, but this still is. So there's a reason. I'll give you an example. The biggest example is land. A bank cannot lend to land. NBFC can. Another reason is securities. So if you give a bank 100 crores of securities, a bank can give you a loan of 20 lakhs. Because that's the limit they can lend.
Oh, okay.
But if they give you a loan for another purpose, you can give securities against that as collateral. That's a different thing. But the idea being that as with securities as collateral for a core purpose, you cannot give a loan for more than 20 lakhs to a retail individual. So what do? At some level, you have to go to an NBFC. NBFCs are big. We have seen recently some issues with, say, GM Financial being told about how what they did was perhaps they're doing IPO funding with 100 crores to a person who's only getting 5, who has only capacity to handle 5 crores worth of loans and so on. So the idea was this NBFC regulatory arbitrage was much bigger in the past. NBFCs could do a bunch of lending, which banks couldn't. And therefore, NBFCs got in. Now, honestly,
NBFC is also regulated by RBI only, right?
NBFC is also regulated by RBI. Again,
lighter touch to some extent.
It has been lighter touch because, for instance, NBFCs do not have to have something called priority sector lending. Okay. If you deposit 100 rupees with a bank, 20 of those 100 rupees have to be given to the government as a loan, as lending to the government. 40% of the remaining, which is 80 rupees ka 40%, will eventually have to be given to something called a priority sector, which the government determines is priority for them. Or government is an RBI here. They decide that, steel or this kind of industry is priority, or that microfinance, small loans are a priority. Low cost housing is a priority. So these loans have to be bought. If a bank does not have enough loans in that category, the remaining money has to be placed with NABARD, and NABARD only offers 6.5% as an interest. So effectively, you get lower interest on the amount. So NBFCs have none of these regulatory pains. But recently, the top level NBFCs have changed have changed in the sense there's something called NBFC UL. Now suddenly we get into these acronyms because regulatory oversight becomes different, right? So we want to regulate you, but we want to regulate those people a little more. So they're the upper layer of NBFC. They now have to put 20% of their whatever something into government bonds. So NBFC is like, excuse me, wait, I'm not that kind of a thing. No. You guys are big. You're too big, and therefore I need you to. So this liquidity coverage and all of that stuff, which is coming down to NBFCs, has reduced a little bit of that regulatory arbitrage. For instance, now banks cannot do IPO NBFCs cannot do IPO funding of more than 1 crore or something. There was a proposal that said that we will limit it. This has also created another layer of a regulatory arbitrage, but has narrowed the layer of regulatory arbitrage. But the third big thing in Bajaj Finance, and we don't consider it, is, remember I was telling you that regulators don't like things growing too fast. Right. So when something grows too fast, the regulator comes after you.
It says you must be doing something wrong.
Or you must be, tell me which drugs you're taking, etc., etc. But you can't do that to a Bajaj because he's
well regarded,
well connected, they are well regarded. they're not pushovers. You can't muscle them around, right? So I think that also helped. It isn't that other people weren't. There were lots of other people who
with
also
famous last names who
famous last names.
couldn't do this.
Who couldn't do this. But these guys were both good and were not pushovers. And I think India has been, or probably is also at some level, a certain layer of understanding the regulatory, getting respect from the regulatory system helps. So, to be fair, even today in the Supreme Court, they say that, what's the difference between lawyer A and say a Ram Jethmalani?
Well, he's no more.
But at the time that he was. Because if Ram Jethmalani came in, the judge is like, this guy has seen more court cases than I have. Okay, sure. So at some level, there is that serious respect. Say, I'm not going to, because if a small judge comes and makes a stupid argument, you're going to be like, so a small lawyer comes and makes a stupid argument. The judge is going to be like, excuse me, can you please be a little more mature about this in my court? You are not going to say this to Ram Jethmalani, even if he makes the most immature argument in the
I have to say, from what I saw later, he was quite a firebrand.
I understand, yeah. So you couldn't, for instance, I could, because I'm not a judge. I don't care, and I can still tell him that this argument is downright immature, but a judge wouldn't. And even though because the stature of the person making the argument in India matters significantly more, unfortunately, than the merit of the argument.
However, since you brought that up, at least when you look at SEBI and RBI today, they seem far less enamored of last names and background, and they seem to be, at least today in recent years, they seem to be able to go after people because they take advantage of their standing as promoters and all to do stuff that other people wouldn't be able to get away with.
I think I hear you there, but I also think that there are still vestiges of the past, and one of the reasons is simply that if you ruffle too many feathers as a regulator, the Uday Kotak is an example. RBI went after him for whatever that promoter ownership thing was. He went to court. And I think he's one of the few people who could take RBI to court and live to tell the tale in the sense of that. Yeah. So in the sense of anybody else, the RBI would be very vindictive. And I'm not saying this as a person who's saying that this is a bad. I'm telling you this is the fact. This is the impression the industry has, is that if I go against the regulator, they will be vindictive towards me against everything else I do, which is not the good impression to have, but this is the impression. And it's the same with even SEBI. You can't easily fight SEBI and then expect that tomorrow in another license that you apply for, they will behave with you in an even. It's just an impression thing. Maybe it's not true, but it's come down to that, right? So at some level, that having that stature helps in the sense that saying that, listen, they can't be vindictive towards whatever. For instance, I don't think if Reliance were to do XYZ, they would be treated exactly at par with what some random person who does XYZ. I think that part still remains, but you have a point that it has come down. There's a little, so it's good to build a great last name at some level, but I think you're right in that it will matter less and less going forward as systems get more institutionalized and all that stuff.
I was thinking also one of the reasons though is that you were saying there's a big difference between startup culture and say established institutions culture, because startups have this imperative to grow and almost don't take compliance as seriously as certainly as bank managers. To that extent.
Absolutely right. Why? Because if you look at the startup playbook, they're looking at this large market and saying we need to grow as much fast as we can and as well as we can. A, before competition gets in, and B, before our next round, because we're going to lose money doing this and we need to keep funding ourselves. So to that extent, certain times the compliance rule book becomes a little, they do compensate on that and overcompensate. And I'll tell you, it's a very complex problem because you need to go to investors saying I need to go 30%. Some people will, in other fields, non-financial, they'll buy their customers, right? So they'll give them discounts. Yeah. You can't do that in the financial world. You can't tell a customer, I'll pay you to give me money. Yeah. Because RBI is going to look at you and say, excuse me.
Stop.
And then you will not hear the end of it. But if you don't do that, then what do you do? So there will be some places where you might say, I won't pay you directly, but here's how I'll pay you to do this. So for instance, in the payment space, we had a lot of people doing cashbacks and all that stuff. Not that cashbacks are bad. I think cashbacks are good in general. People become richer with cashbacks. That's all fine. But you couldn't do cashback with financial products. And therefore, the ability to use the same playbook on the payment side will not translate to a playbook on the bank account side or deposit side and all that stuff. the idea would be a little more complex. So the idea also means that sometimes compliance falls off the wayside because startups don't understand the nature of this business. Then I say the nature of the business is, why do you have to make this compliance? Isn't this too onerous and unnecessary? That call, I think, has to be taken in a more mature fashion. It does, in India, everybody is a criminal by default, right? Because there's so many rules that complicate each other, that contradict each other, that you will not ever be,
completely
out
in
there.
the clear. Yeah.
So the idea is there's lax enforcement, and at some level, because even the courts recognize that these laws are more or less like ambiguous, and there's no definition. The courts recognize that unless you're like so deeply in the wrong, egregious, you're not going to, they're going to come after you. And sometimes these laws are used against you. Oh, I'm sorry, you put your left leg first. You're supposed to be right leg. You should know that. You've been in the industry for so long. But these kind of rules are petty and meaningless, and nobody wants to change them. As we have found recently, regulators don't want to change laws because even though the law is stupid, in many cases, or the rule is stupid, a regulator is a person, right? There's a human being there, right? That human being is like, listen, if I remove this rule saying it is stupid, then there must have been a reason why this rule was created in the first place. I don't know what the reason is. Maybe that reason is completely invalid. There's an old story, right? It was of this woman who was saying, I'm cooking a turkey or a chicken, and the mother says, you need to cut the wings off. She's like, why do you need to cut the wings off? I don't know, my mother told me to cut the wings off. And then she go to the grandmother and says, well, why you keep telling me to cut the wings off? Why do you have to cut the wings off? And it goes on. There's a great grandmother involved. The great grandmother says, well, because my pot wasn't big enough to keep the chicken in. So the sometimes the reasoning of a law or whatever rule has reasons why it doesn't exist. Like my mother used to tell me, don't cut your nails in the night. Like, why? And then I find out the real reason at some point was there was no light. Yep. You would end up hurting yourself if you cut your nails in the night. But then now you have light, so you don't need that rule anymore. But you had this. So because the rules were so, have no, there are regulatory rules also, and these are superstitions. We laugh about them, but I think there's a rule that says you need to write, I understand these rules and regulations in the PMS. The PMS industry is the only industry where you have to write, I understand these things.
Is that still required?
It is still required, but you have to handwrite it in your handwriting.
I understand.
Now, I'm like, okay, I can't sign a statement that says, I understand. I have to write, I understand. Obviously, there was some history to this, but perhaps some of that history does not apply anymore. Because if you're saying that people will sign anything, then we should we should get them to handwrite everything. Or we should get them to handwrite nothing. But obviously nobody's going to change this rule. It's not because, it's this thing. It's just that how do you prove that they understood these rules unless they handwrite it? But you don't ask them to prove anything else by handwriting. Everything else is written in a signature below a printed document. No, but somebody made this rule. So obviously. So the idea behind compliance has to be to identify what rules are something that in spirit have to be followed in a certain way. And in some cases where you can argue with the regulator saying these rules are not with the spirit of whatever you guys actually wanted to do. So we are actually following it in spirit, but maybe if there was something small, the regulator is willing to overlook that, right? But the regulator will not be willing to overlook that, oh, you know what, the guy gave me a tissue paper and I used it as KYC. Because you're like, oh, obviously to yahi rehta hai. He came to me from here, that must be his address. But he has no address proof of it. And you can't say, I don't have address proof. You have to have some kind of address proof. Banks have overridden it in certain ways. So for instance, banks are given this flexibility. They're told, you are the arbiter of people's address.
The current residential address.
Yes, because the only other people's of arbiters of address are things like
Gazetted
passports
officers,
and gazetted officers and all that stuff who have power. So you give power to a bank that says, you can say that this person's correspondent is X. You have to verify it by sending a courier. That happens or not is, irrelevant, but the banks can effectively say that you live here. You live here. This is great. But fintech that is not a bank cannot say that, oh, just because a bank is allowed, maybe I should also be allowed. But they've got that specific power. So I think this compliance feeling is a thought process. And, as Capitalmind, we've gone through down this way. We're on the overcompensating part of things. We will overly be rule bound in order to not be against the rules of compliance. And maybe because of that, we lose a little bit of business to other people who are not so rule bound. Somebody came to us and said, but other PMSs have done this. We're like, we're not allowed to do this. I don't know how they've done this. But, that then the business, we have to kind of compromise because they're not willing to give you a set of documents that you need to follow your greater compliance. But I think that's also a problem of, either us being overcompensating on that thing, which is our problem, but also that the rules are not well defined and clear. You just have to do this and everybody just does this and we're fine. That would be nice. Given where we are, I would say the fintech players and Zerodha is actually, something that I learned from Zerodha as well is you do overcompensate in terms of regulatory efforts, and it will serve you well in the longer term, even if you have to spend more money doing that.
I'm coming back to the unbundling and bundling thing I started with. A few years ago, there was this thinking that, I guess this comes up often, is that lending was the holy grail business model in all things finance. But the way you've described it, banks who have the ability to lend, I guess almost in theory as much as they want, print down balance sheets, use it carefully and sparingly. So could you talk me through, why aren't banks just super aggressive on lending? What's the issue with lending here? And maybe we can then make this feed into the Indian bankruptcy code as well.
Yeah, absolutely. I think, one of the problems over here is, why do banks not lend like crazy? Or, well, they've been burnt by it, but we'll come to another concept. And why is lending so attractive to all of the players, right? In the end, you start off as a brokerage, suddenly you're offering lending. You start off as a mutual fund and you want to, so there's a mutual fund EMC, and start a lending arm on it. We will eventually want to start our own lending business at some point, maybe 10 years later. But there are two reasons for it. First, there is eternal demand. Credit is one of the products which you will have demand from the rich, the poor, everyone in between at various times to buy assets, to fund marriages, to X. So you have eternal demand no matter what. So if you have an unlimited demand product, there is no point in which you say, listen, we are saturated. There's no saturation in credit, right? So you end up with credit remaining all the time. This, I think, is a very interesting aspect of it that drives everybody to lending, because that's the holy grail, because that's where money is. Second, the margins here are higher, and an asset management business we make 0.5%. A lending NIM can be 12-14%, which means I can borrow at 10% and lend at 25%. The zero cost EMI we talk about is actually a 25% product.
Oh yeah, because of the discounts they get from...
from the manufacturers. A 3-month product with a 5% discount from the manufacturer given to you at 0% EMI with one EMI in advance is a 25% return on IRR for the lender. The problem with this is nobody sees it, but it's only lenders that can make this money, because they will give it to 100 people, then after 2 months they'll be able to rotate the money. You have to be able to rotate the money, otherwise you're not going to make that IRR. So if you're able to do this properly, you're actually lending at 25%. And because you're lending at 25% and you're borrowing at 10%, you have a margin of 15%. You can handle a few defaults in that. So maybe 10% of your customers default, you're still okay, because you're still making a 5 or 6% net of that. A net of that regime, a thought process would mean that if I lend 100,000 crores, and I can lend 100,000 crores, I can lend 500,000 crores. There's no stopping me. Whereas in an asset management industry, getting to 100,000 crores will involve blood, sweat, tears, and I don't know what else. But basically, since it's so much easier to grow your book and you're earning a greater percentage of that book, it's the holy grail. It's like, let's go here. That's where the money is. I would say insurance is one of those products, but insurance has no growth. Meaningfully, it grows at maybe 10 or 15% a year. A new player will come in and try and get market share from existing guys and therefore increase that footprint a little bit more. But the other part about lending is, and maybe I should go down this route a little bit. A lot of fintech players have gotten into lending because it's cool, it's unlimited demand. But lending is not about lending. It's easy because it's unlimited demand. If I tell you I'll give you money, you'll be like, where do I sign? The problem in lending is 2 layers. First one is to recover the money. Second one is, where do you borrow the money from? Address the first one first. How do you recover the money? Is if you consider that your problem first, you would not lend uncollateralized at 10,000 rupees, because it's impossible to even justify trying to recover a 10,000 rupee loan. So you're giving a 10,000 rupee loan to buy, I don't know, a TV. It isn't even worth the time spent to send someone to your house to recover the TV and try to sell it. Because in the end, I'll probably recover 2,000 rupees, which is what I'll have to pay the person who went to your house to recover the TV that amount in the first place. So it net means nothing to me other than teaching you a lesson. After a while, education of this sort is not meaningful for any lender, right? And sometimes the TV will actually fetch less than the 2,000 rupees I have to pay the guy anyways. So there is no point attempting to recover really small. But yet we have proliferated a lot of small loans at that level. So this is an inherent feeling that people will pay back all the time. I think most people do want to pay back. But there's a lending spiral that happens, borrowing spiral that happens, which is you give people like easy access to money. They think that's easy access. They don't realize they have to return it. You haven't educated them in the fact that you're charging them a ridiculously high interest rate. Sometimes, as in microfinance, it's 35, 40%. Credit cards are 35, 40%. In credit cards, the default option is to pay the minimum amount. Why? I think the minimum amount should be banned. If you have to go through a written exam to pay only the minimum.
You have to say, I understand.
Yeah, and I understand. And you have to handwrite a whole letter in English backwards before you kind of, are allowed to do only minimum amounts. And if you did that, then yes, you can earn the minimum amount payment. Otherwise, you can't. If you did this, the whole credit card industry would send goons to my house. Because they don't do that anymore. They don't do that anymore. But the problem is that the borrowing part of this, the recovering part of the credit is a meaningfully important thing to consider before. Which is why when I went to a lot of a lot of the places where fintechs startups would present their cases. So there'd be startups would say, we've been 1 year into the business and we have 0 defaults. At which time I'm like, wait. That does not mean it's a good thing. That means you aren't even mature enough to have seen defaults. The whole P2P industry tries to say, downplay the amount of defaults that happen. I'm like, no, upplay. Charge a higher interest rate and tell me the real story, because I'd rather have that than the
false confidence.
That there's no defaults. And that's another unfortunate part, because this concept of recovering is more important than the concept of lending. The other part is the concept of borrowing. Startups are like, we're flush with money. We can lend this money. Lending your own equity is like, okay, I'm sorry for saying this.
It's a proof of concept at best.
At best. And it's the dumbest idea on the planet. Your return on equity will be 4%, because that's the NIM you're earning eventually after all the defaults and all that. 4% ROE is better to not have that equity and just put it in the bank instead. It's going 6%. So I think it takes some time for people to recognize. And they say, okay, we can't earn ROEs of 6%. We have to go and earn ROEs that are higher. In the lending business, you will earn ROEs of 20%, maybe 25% at max. Anything more is unsustainable. That means you'll earn it. Please thank your stars for whatever time you earned it, but you will go back to that 20-25%, or you will go back to minus 20% because you will make losses. So at some level, your steady state, that's the kind of numbers. HDFC Bank earns 16-17%, and they consider it great. Bajaj Finance earns about 19-20% sometimes. Sometimes it earns a little more. And so the idea over here would be that the lending person should be considering trying to improve their borrowing score. How do you improve your borrowing score? It's like saying, how do you crack IIT? Nowadays, it's like, you should have planned it before you were a fetus. That's a different thing. But for normal, at times when I was younger, which is a long time back, unfortunately, but you would start from your 10th standard maybe, or 11th standard, or maybe 9th standard. So you start studying from that time, and then you get there. Right? So to build a low borrowing cost, you need to start 3 or 4 years earlier, which means you need to borrow maybe at a higher cost to give confidence that borrowing has to come from different sources. It can't be just from a bank, because one source means they'll kill you. You're over dependent on one source. So you do a little bit of banks, you do a little bit of bonds. You sell the bonds to retail, you sell the bonds to corporates and to larger players, and you sell the bonds to institutions. So you get a wider diversified base. If you grow decently enough, you'll even get foreign investors interested in buying your bonds. This is a diversified borrowing book. It will not happen in one day. the foreign institutions don't give a damn about you for day one. It's probably some retail players, some good friends who will probably put in the money, but tell them not to give you the money directly. Tell them to go through a bond market system that they will buy your bonds in. The early players go in there. You build this book over a period and build the confidence over a period of 3 or 4 years. Then you have a business. The borrowing part of this business is not considered by NBFCs, I mean, for a lot of fintechs at all. So they're almost like, in the end, what do? We have to go to a bank, and the bank is refusing to give us a loan. We have finished. This is exactly what happened to one startup about 3 or 4 months back, where they're like, no bank is working with us. We're done. No NBFCs also. Yeah. They had to shut down because the fintech was relying on an NBFC to lend loans to their customers. They didn't have any concept of, so at some point, while they had a set of customers, those customers only wanted loans. And if you didn't have loans, they would stay with you. I mean, if you couldn't give them loans, they wouldn't stay with you. And it was, so I think the idea over here would be understand where the borrowing also comes from. And recoveries, there's another part of things. A loan is good if it has either at least 2 of the 3 things, which is collateral, credit worthiness, and income, which capacities, 3 C's they call it, right? So I cannot easily estimate income from a person. I can look at his LinkedIn profile. But if I know you're looking at my LinkedIn profile, I will fake a LinkedIn profile.
Because all LinkedIn profiles fake.
Well, many of them are, right? So they're conveniently. So if you thought that my LinkedIn profile was a great way to assess my income, people will fake it. People will fake, the observer changes the observation, right? The fact that somebody's observing it will change the observation. So this reflexivity has to be translated into, I can't use only that, I have to use better technology. So maybe I'll use an account aggregator. So, and by the way, all of these things come down into the regulatory space as well, which is like RBI is saying, listen, you can getting into the space, I need you to somehow be regulated by me or work with a regulated player. You want to do account aggregation, find out people's bank account balances, come through an account aggregator or be an account aggregator that is an NBFC that is regulated by me. Do you say that you don't want to take the risk of lending and therefore people can lend to another person directly and you just facilitate the transaction? You are, I'm sorry, but you're a P2P lending NBFC, which is regulated by us. So then, oh, okay. And then they kind of go down the regulatory route. But the idea will be that eventually RBI will come in and regulate some of these conditions quite stringently because they want you to operate with regulated players for 2 reasons, unfortunately. And, one of the reasons is they like to control the space. But there's also that there's enough precedence that startups do really stupid things. And some of them I don't agree with. For instance, I don't agree that Forex can only be regulated by a bank. I think you should give the Forex market access to every single player who wants to access it directly. While there are such rules, it's very difficult for them to disintermediate it for other players. And I think that is a problem. That we should allow more players to come participate. RBI is open to these suggestions, but they're not. It's not yet happened.
Conservative. My last 2 questions. Can you talk a little bit about staying with lending? And I guess this is when things go wrong with lending. The IBC, the Indian Bankruptcy Code, right? And then I just wanted to ask about, fine, given all your various observations, what do you think is a way to change things about the system? But IBC first.
Yes, the IBC. So IBC was this fantastic thing, right? So there's a bankruptcy code. Let me give you the hardcore history of this. Was earlier people would go borrow from a bank. I'm a corporate, Shrey is a bank. I come to Shrey and say, I need 100 crores. Yes, take 100 crores, run your business. I go there and say, I don't have 100 crores to pay you back. So she's like, what do I do? And I'm a listed company with stocks in the stock exchange and all that stuff. So I own 50% of my business. The stock market owns the remaining 50%. And then, you come and say, and by the way, this is not some of the largest entities. So I'm not going to name names here.
Please don't.
But they would go to a bank and say, we have this problem. And the bank would say, fine, what do we do now? And then they'd say, let's go to the debt recovery tribunal. And then you go to the DRT and sit there for a while. And then you say, well, you know what, Shrey, it's not working. It's going to take too much time. Why don't you do this? I can't pay you back 100 crores. I'll pay you back 50. And guess what? You should give me a loan anyways, right? So let's just make that loan from 100 to 50, just write off the 50. Then we can continue. Otherwise, you'll have 0 because the debt is. So they said, see, you're like, Deepak, that's all. I'd rather recover 50 than nothing. But let me take, you know what the problem with this whole situation is? I have made you write down the debt by 50%, but you have nothing to gain from it, right? Which means my shareholders who were currently in a company that was technically bankrupt suddenly got a lease of life by saying, oh, this guy's got 100 crores, now they have to pay back only 50. Fantastic. We get the benefit of the upside. Why are my shareholders getting the benefit of the upside, but the bank is not getting any shares to participate in the same upside, right? Instead, the bank should have said, guess what, you guys, now I own 60% of the business. You own the remaining 40%, out of which 20% is the promoter, 20% is everybody else, so fine. But I own 60%. You recover, I will get some money out of my 60%. I will sell it in the market, and then I will go back to running my own business. Why don't I do this? Banks should have been asking these questions, but there were rules. RBI said a bank cannot own more than 10% of a company. Why? I don't know. But they couldn't own more than 10% of a company. There were other reasons that promoters would say, wink, wink, nod, nod, and then money would change hands at some level, and then therefore banks would be okay. But come the IBC, some of these things changed. The IBC is a new code which says, well, you can go back up. You can declare bankruptcy. Well, what does bankruptcy mean? Bankruptcy is actually a protection against your lenders. So if I have 100 lenders, I say I'm bankrupt, everybody comes to the table and say, this company owes me so much. And then somebody else, a resolution professional, gets appointed. He takes over the company and says, well, you know what, the company has so much assets. We will now auction it. We will auction not the assets, that's called a liquidation, but we will auction the whole company and say, will somebody come and resolve this? There's a debt of 100 crores. How much would you bid for it? A competitor. Now, the promoter himself cannot bid. This was the new law.
Yeah, okay.
So, the promoter can't bid, the competitors can, and they come and say, like in SR Steel, where the promoters were not allowed to bid, Arcelor came and said, I'll bid. I'll give you some money. I'll put some, it's 48,000 crores, I'll give you 35,000 or some, I don't remember the exact numbers, but so you got a great steel company for a price that was less than the outstanding debt. Bhushan Steel was 36,000 crores of debt, ballooned to 50,000 crores, was eventually bought by Tata, and Tata loved it because Bhushan had this auto grade steel plant where there was very little or no auto grade steel producing capacity in India at all. We would import steel for making our cars, and now we don't, because now this capacity, except that that particular company was too aggressive in its borrowing and therefore was not able to repay the loans on time. Tata Steel, when they bought it, eventually they bought it for a price that was not even a haircut or a meaningful haircut for the banks. So essentially what happened was two things. You went through the bankruptcy, you got protection. So the acquirer got the thing that, listen, all the sins of the past are washed off. In court, nobody can come back and say, you owe me money, because you went through bankruptcy. If you didn't have a claim at bankruptcy, you don't have
one now.
So all the sins of the past are washed off, and you get a certified figures, and this is the number. The banks are like, listen, I got a haircut. I was going to take a haircut anyway if I give it back to the promoter. I got a haircut, but now I got a competitive haircut because a competitor bid for it. The promoter lost the company. And the promoters are like, listen, I didn't think of this because this is a business, right? You would say, I'll take a loan, then you would siphon off some money, and then you'd say, please write off 50%. Everybody winked, everybody was happy. Somebody lost money, but nobody knows who. Eventually, it was a taxpayer. We didn't realize that, but effectively, this was happening. So now suddenly you have the system where there was no equity also being transferred. Here, equity was happening. So for instance, in Bhushan Steel's case, Bhushan Steel was a listed company. When Tata bought it, they said, okay, you can continue to be listed, because at that time the rule was that you had to continue to stay listed. SEBI did not modify its rules at that time. So Tata Steel owned 75% of the company, 25% has to be in public hands. But they also had warrants that could convert to a point where they would own 98% of the company whenever they wanted. Eventually, this was merged into Tata Steel, and therefore these warrants were kind of adjusted against each other. But essentially, shareholders saw an upside. But guess what? Banks also did, because 75% was owned by Tata Steel, but banks got another 20% or 15% of the company. So they saw the upside of whatever Bhushan Steel would have seen when it merged into Tata Steel. Tata Steel has done fairly well since. If they handle the shares, it's a good thing for the banks. Also, say RBI relaxed the rules that said a bank cannot own more than 10% of a company. That said, if you go through the bankruptcy code, you can own whatever percentage of the company that you want.
So this sounds like a great deal for banks. So then what's going wrong
So
now?
guess what happened? Yeah. The result of this was corporate borrowing came down because a lot of the borrowing was bullshit, right? It was like expected to be waived off. Suddenly they're like, dude, I'm not losing my company. I don't care about all this other stuff, but you're not taking my company away from me. So the corporate lending from between 2015 to 2021, 22 was flat. The economy grew, but corporates actually pared down their lending, which is great because banks then built the retail books and all that stuff alongside. While the corporate lending came down, the corporate book became much more stable, and the corporates themselves with lower debt have a lot more capacity to take on more capex today if they want. So a lot of the capex was bullshit, gold plated, built to take out loans and all, take out this thing. But the other problem that has happened now is that banks have suddenly started to realize that if you take a company to the bankruptcy court, you're guaranteed a haircut, and sometimes it's a very large haircut because it can be a long time also. And people will go to court, they'll fight, they'll do this. Bush and Steel took like 4 years to resolve, and it took some time. So a lot of times the assets actually go. So now the promoters are pushing back and saying, why don't you take the haircut instead of taking us to bankruptcy court for 4 years? At the time IBC came, RBI forced banks to say, your top 20 borrowers who haven't paid you, who are NPAs, please take them to bankruptcy court. Then they said the next 30 also take them to bankruptcy court. Now RBI said, no, you figure it out, do it yourself, and don't ask me to make orders. The banks are like, yeah, RBI is not saying that we have to do this. So can we talk about. So recently, I'm talking about the last year or so, a lot of companies are saying they're bankrupt, they're not being taken to bankruptcy court, and yet banks are settling with them without equity, which means a listed entity is the promoters going and saying, just write off your loan, and the bank is asking for no equity whatsoever. This is bad. This is going back to the earlier practice. So I think the RBI should absolutely say, if you're writing down a loan, take equity. Or write off all the equity in that company. Everybody should go to zero, and then you should take a haircut on that rate, and then let the promoter develop it further and all that stuff. That's fine. But basically, equity shareholders should not benefit really at the cost of debt shareholders. And I think a lot of precedent, there have been one precedent in which was bad, which was 81 bonds in Yes Bank's case. But I'll tell you that 81 is neither a bond nor a debt instrument. It is the most toxic instrument known to mankind. Probably not, nuclear bombs are most toxic.
No, I take your point.
But these are the equivalent of financial nuclear bombs, because essentially they're telling you, you'll make 10% on the upside and forget return on capital. You won't get any return off capital on the downside. You lose all your money on the downside, which is almost like, I didn't sign up for this. This is not a bond. And when I lose all my money, I lose it before anybody else in the company does. And if it makes the company healthy, everybody else in the company will continue to make money. That is as toxic an instrument as it gets. But anyway, leave that aside. I think the idea being that if a debt person has to take a haircut, the equity, and startups can help here. If you created more banks, and maybe they'll talk about how to fix the problem.
So let me get there. So you were leading up to it. You've talked about, if I may say, you've talked a lot about the issues. How banks play perhaps an oversized role, how RBI is fundamentally conservative and careful with this and doesn't want people to grow too fast in the fear that they'll end up doing something which will cause pain to, whatever, end customers and so on. But then what is, in your view, then the solution to this? Because the fact of the matter is that it's because of this conservatism that we seem to have fewer financial crises than other countries, I would like to think. And our banks, by and large, are trustworthy. We don't have as many Silicon Valley Bank type incidents in India. So, in your opinion, how do we sort of keep the best of what we have, but then still have great growth and reach out to more and more customers?
Exactly. Very interesting story is that the Silicon Valley Bank was one of those super conservative banks that got screwed only because the government bond deals went some toward.
Duration risk. It's a real thing, right?
Yeah. And it probably will happen in India also if exactly the same way, if that if we had such low interest rates and they went up so much, right? So I don't think but I do think, yes, we've had a conservative system and things have been good, but I think at one layer we have over-regulation. And I say this just as regulatory pressure is increasing, but I do say this that we have regulators who we are afraid to talk to a large extent. They are open to a large extent, but they are not swift and they don't want to change rules very fast. So to that extent, I think over-regulation is a concern. If a regulator says you can't talk, at some level you realize that you have to talk, and otherwise your business won't run. And then you can't not talk, but you can't talk also. And so it becomes a situation where the regulators have to be a little more understanding of how the business model is. Maybe over time it's our job as players to tell them about all the various things that are happening. And a lot of things that are happening are wrong in the regulator's eyes, have always been wrong, but they've been continuing for the last 2 decades. We've talked about HNI IPO funding 2 years ago. And only now there's suddenly, do we get a thing saying, oh, maybe this is not right. Well, of course it's not right. There's no concept of 100x IPO oversubscription unless somebody has levered himself up the wazoo, and the only protection is that, oh, we will not get allocation. So I don't think I think the regulators are behind in some circumstances of regulating, but they're also way too conservative in others. Well, why should Forex be only a banking thing? Why should we have such stringent rules about who can borrow? Why should we have a rule that says if you are a company that has 50% of its assets or income, and I don't know which.
I think it's an and.
It's an and. So, and income. So, if it's a company that has just made too much money and it's sitting there in the company's books and it uses it to buy mutual funds, and for the some strange reason, because it has made so much money, it has not yet started to make a lot of revenue from anywhere else, it makes a lot of revenue from the mutual funds as dividend or whatever, then you have to actually call it an NBFC.
The deemed NBFC.
Deemed NBFC. In the NBFC. So I'm like, excuse me, why? That also means that at the smaller level, capital is constrained, right? So you have a lot of constraints on capital at the smaller, tiny shop, small business level. Currently, the only way to solve this is if you want to pool together capital to invest in a few businesses like this. The only way to do this is register as an AIF with SEBI or register as an NBFC with RBI, both of which require significantly higher amounts of capital. And I think doing something at the less than 5 crore, 10 crore level is not system harming in any meaningful way. Why can't we have it such that companies of the sort that actually fund businesses should actually, with limited liability, so that you don't have too much liability? Why can't we say that they don't have to register as NBFCs? I think that's another part of the process that is. The bigger problem is also that RBI is too big. I think, and I've written about it in 2011, I still continue to say it, we should not have so many functions in one institution. RBI is the bank regulator, so it's also the entity that effectively sets interest rates. When I say effectively, the repo rate comes from something called a monetary policy committee, but a lot of the rates in this banking system are set by liquidity operations that happen at the RBI. So RBI is also that. Fine, you can have all this. It's also the merchant banker to the government. It issues effectively the treasury bills and the T-bonds that the government effectively has to pay back. It is also the bond market regulator. It is also one of the largest players in the bond market. It is the forex regulator. It is one of the largest players in the forex market. It does things contrary to other players as a competitor, but it's also the regulator. So it's almost like my bat, my rules, my whole ground, and I'm still a participant in that. You don't need all of this. In the US, you have separate forex regulators, you have separate banking regulators, you have a separate banking insurance company, you have a separate treasury bill issuing agency. You have different agencies for each of these things. I would say, you have to go down that route also because it helps the fintech players then have different regulators to deal with for different requirements. You will eventually need to do a lot of things, right? And because you need to do a lot of things, the fact that a regulator has said no to you for whatever reason should not really reflect on what another regulator does. But if the regulator is the same body, it's
That
RBI,
stigma will stay with
then
you.
the stigma stays with you, and then people don't, they don't want to do those multiple things. Although you may be suited for one but not suited for the other, there's no way to kind of different. I think that's also a regulatory problem that we have. Solving this problem also involves a lot more compliance for the startups. I think in general idea should be err on the side of caution, but at the same time look at spirit of laws rather than the letter. The letter can be completely nonsense, and you have to engage with regulators in order to run this business in a meaningful way. And I'd say the opportunities are large because RBI, for instance, it went beyond the banking system in a lot of things. The Bharat bill payment system is set up by not having banks run the entire operation. The Bharat bill payment system is a BBPS. It's called. There's a BBPS OU and all sorts of things where any fintech entity, any entity can become a payer and a receiver and a transactor of the system by just registering through this process. So it's not restricted to banks. There's an overarching system. The similar system exists in a bunch of other places. There's a factoring system called, I forget the name of the thing, but we keep talking about it. But it's relatively a new trade discounting system. The idea being you can discount your bills. Now, discounting your bills is typically an NBFC territory or a bank territory. But the way this system works is that you have to deal with every NBFC or every bank on a unilateral basis, like bilateral basis. So that means you go to each one, give them your documents, they give you a rate. You want a competing rate from somebody else, you give them your documents, and you get a competing rate. But what if you brought all the documents into one system? It's a bill payment system. Somebody has to just say that, listen, I'm going to pay this bill, but I'm going to pay it after 3 months. And that somebody can be a government company. It can be a large corporate who, you think has no problems paying, but the payment terms are 90 days. The guy who's on the other side of the bill needs the money in much earlier. Now, there is an actual discounting system for this called trades. We should actually embrace that. A lot of startups are actually going and build their own, which I think is it's not as trustworthy as a core discounting system set up. But here again, you don't need to be a bank. You can be a bank or an NBFC, but it can also be a third layer player in trades. I think having some of this is useful and interesting. You would, in the end, since everybody wants to become everything, having these tools or different areas would help. Tomorrow you can have a similar system for Forex, saying, you know what, maybe the authorized dealers just need to be a part of the cog of the wheels. We can have electronic trading or quoting on a common platform that is instantaneous and like UPI, ubiquitous across the industry. You don't have to have UPI's unfortunate problem is the bank is the effective controller of a lot of things, but they've kind of come to an agreement in that. On the other hand, in a lot of other places, the fintechs, okay, maybe this is a larger thing and I'll end with this. The end idea of having many services to offer to the customer is that you own the customer. And the fintech space is rife with players who think that they own the customer. But they are just, the regulatory process involves them having to go through the bank. What we don't understand is the bank is also a person who thinks and who actually genuinely owns the customer. Therefore, expecting that a bank will allow you to own the customer and you cannot report to the customer, you cannot talk to the customer, you cannot do KYC on the customer yourself is downright dumb. We need to get to acceptance on this fact that every regulated entity has to own all its customers, and they're giving you some kind of privilege, and that's how the system I think will develop. Either that or become a regulated entity yourself and then own your customers outright. But to do anything on the edge of regulation and own the customer is going to be difficult. Without owning the customer, you're not going to be able to offer them the gamut of services that you really want to. I think this has a great future for us, for all of us in place. But these ground rules, I don't think they'll change.
I'll try and get the last word in. Paul Walker once said that the ATM was the last financial innovation that was useful many decades ago. But clearly you don't think so. And there needs to be a lot more innovation, both in the regulators and in the financial products offered going forward.
Well, I think he'll change his mind after UPI. So
There is no more. He didn't get to see it.
Great. Thanks, Shay. This was fabulous, and looking forward to the next time.
Well, that's our show. Thanks so much for listening in. If you like what you heard, do visit capitalmind.in to learn more about how we think about markets, investing, and the like. You can find more about our podcast at capitalmind.in/podcast. And do subscribe to our channel to get the latest updates and see our newest videos.